Trading Justice episode 575. We're going to talk what is on everyone's mind, market corrections. How deep can it go? What should you look for? Where's the bottom, right? I mean, is this going to turn into the great bear market? Listen, I've seen all the headlines this weekend, but we're going to break it down the way we do, precisely, and with some damn good analysis thrown in there to boot. Matt, how are you doing? Are you excited to talk market corrections? I know from just a left-brain geek, technical, you kind of like this stuff.
I don't mind a pullback in the market. I see most pullbacks as opportunities on the buy side of the equation, but that's really as we come to the culmination of the conclusion of the market correction saga. And standard market corrections can take weeks, some can take months. We don't get to pick when that correction wants to end. We just got to be prepared and understand where these key levels of support are, so that we know, kind of in that zone where the market should start building support. And then what are the potential catalysts that can come out this week that have the ability to change the market reaction to the last couple weeks, which have been, quite frankly, a bunch of heavy selling.
A bunch of heavy selling indeed. We're going to break it all down. But before we get going on market corrections, I want to highlight our Tackle Trading newsletter that is out for pro members this weekend. Listen, you join Tackle Trading for this newsletter. It is fantastic. I know I write some of it, you write some of it, Gino writes some of it, Matt. It is worth the price of admission for a pro membership. And when you join Tackle Trading for the newsletter, you're going to stay for the community, which is just fantastic. Helpful coaches, fantastic members, just a great energy in our community during bull times, bear times, corrections, during it all, Matt. But what are some of the highlights from the newsletter? Probably market corrections.
kind of the topic right now. No, I love putting the newsletter together, and it is a labor of love from the coaches at Tackle Trading, no doubt about that. But we want to make sure that our newsletter allows our community and our members to navigate the market on a week in, week out basis without spending a tremendous amount of time trying to understand every single degree of conversation we have at Tackle Trading. And so what we're trying to do with the newsletter is make it that, that product to tackle that our community that doesn't have the ability to attend everything we do, but they have the ability to read the newsletter on a week in, week out basis and have an understanding of exactly what we're seeing in the market and the the sectors that are moving, the market levels of support and resistance, those key levels, what's happening in the gold market, Bitcoin, oil, so on and so forth. And so we there's 5 basic sections of the newsletter. The technical update is kind of the first one, but that's really kind of just 3 basic topics we talk about: technical analysis, earnings update, and then I wrote on the gold ratios, and specifically the gold to silver ratio this week. The second section is usually the sector rankings, upgrades, downgrades. There's videos throughout the entire newsletter as well. So if you are not starting your week out with the Tackle Trading newsletter, I would strongly encourage you to do so, because it is it's turning into quite an amazing product for us at Tackle Trading, and hopefully our membership, our pro members love it as well.
Yeah, absolutely. Listen, I internally refer to, I think I referred to it on the podcast as the Holiday Inn newsletter. Like if you want to feel like an expert in the market, read the newsletter. You will be caught up on every key point with great analysis. And heading into this week, Matt, you and I consume a ton of news. You've seen the headlines this weekend. People out there guessing, this is going to be the great bear. This is going to end. And I mean, they're all over the board, right? Mostly talking their book. But for you and I in these situations, it's going to be a technical story in order to gauge when this pullback is going to be over, because we don't know exactly what it will look like when it bottoms. We don't know how deep the level is going to be, and you never know. And that's okay, right? That's okay at this point in the pullback. but talk about retracements in general, Matt, and then, start applying it maybe to the correction we have from a technical perspective now.
Yeah, for our pro members at Tackle Trading, who's obviously the sponsor of the Trade and Justice podcast, on Tuesday during the coaches show, I'm going to be teaching both the combination of the depth of the retracement in conjunction with market corrections so that our community can truly understand, because you're absolutely right, Mark. You don't know where the end result of this correction is. You don't know if it's just going to be a pullback, a standard correction, or something worse. You have no clue about that. But what you do know is you do know the levels that you need to be tracking. You do know the patterns that you need to see start to develop on the bull side of the equation before you start to be a little bit more aggressive. And so there's a lot of sitting on your hands right now, speaking as the bull side of the equation. Obviously, bear trades have been really, really good, but especially to offset some of the bullishness or lack thereof recently. But in terms of the corrective retracement, that's why when people get really, really caught up emotionally in pullback analysis, I don't. And it's not that, people aren't getting, hit in the face from the market correction. It's not that, at Tackle Trading, the coaches, myself included, are, gonna not get hit when the market goes volatile. When you're bullish and the market turns into a short-term bearish downtrend, everybody's going to get hit in that environment. But I like to look at it from a context perspective. I like to look at it from a historical perspective. I like to look at it from a technical perspective. And when you're looking at it from the combination of a historical / technical perspective, you're not going to get caught up in the emotional side of that equation. You're going to be laser focused on that next opportunity. And in these environments, I typically talk about the need to be patient, sit on your hands, wait out the volatility, don't be fighting the volatility. And what we're really kind of waiting on is we're just waiting on that correction to kind of work through the marketplace. And when you're looking at the market this week, I do think there's two bigger conversations, much bigger and much more important conversations than probably anything else out there right now. And I'd say the first one is, where does this correction end? I think that's the ultimate question on everybody's mind.
Yeah, and I like how you're emphasizing this. It's not what is inflation, what's the Fed going to say, what are geopolitics, what are earnings. It is
they don't matter right
first, because they don't matter right now, because this becomes a living event, doesn't it? Like independent of,
markets are selling all data right now. It doesn't matter what anybody.
Good, bad, it doesn't matter. We'll talk about that a little bit in earnings. I think that's a thing. But it's that's number one, right? So you said that's number one.
Number one is the ultimate conclusion of the market correction. Is it a pullback? Is it a retracement? Or is it something else? And in the newsletter, I made the statement. I gave the analogy of, you remember that old Superman movie where it's like they're pointing up in the sky and they say, is it a bird? No. Is it a plane? No, it's Superman. And I oftentimes get into that same type of feeling here, Mark, where it's like, all right, is it a pullback? No, excuse me. Is it a bear market? Oh, no. Is it a market correction? Oh, no. It's just a pullback. We don't know yet, but what we once again do know is the levels we need to track, and we do know the technical patterns that we need to see when those levels start to build into support levels. And so when you're looking at that market correction, Mark, in terms of the the standardized language of it, I really look at it, and I talked about this in the newsletter as well. When you're going through big picture macro moments, market corrections, are we going to go into the ultimate bear? Are we going to go into the correction? Are we going to go into the pullback? Well, this is a story that's told over time, and we need to track that story being told over time. When you're looking at standard pullback analysis in the market, we categorize these patterns as bullish retracements. As you establish a higher level of resistance and a higher level of support throughout a trend, the pullback analysis is called a bullish retracement. And when you track that bullish retracement, you're going to track 3 key levels of the bullish retracement. The first one is what we call momentum-based patterns. Those are both flag-based patterns. Those are what we refer to as shallow retracements. The second one is more like a bullish retracement, a standardized bullish retracement. We call that more of I call it a Goldilocks retracement, where you're 38 to 50% off that higher high from the higher low. And then the third level that you track is what we call the deeper retracement. And when you're working into that deeper retracement, you're just going to need to see a little bit more in terms of what you need to see from a overall bullish pattern perspective so that you can feel confident that the selling is over. For example, when you're in a bull flag based pattern, you only need simple confirmation.
Like a bull place factor, you could have a day, right?
Oh, absolutely. You don't even need a day. All you need with simple confirmation, the only thing you need is for the stock to go above the previous high of the day. You don't even need to see it close above that in a momentum-based flag, because you're trading momentum. But when you start working deeper into deeper retracement analysis, you're going to need to see confirmation. And that's what I call standard confirmation, where you need to see a close above the previous day's high. But as you work deeper, you got to put in a little bit more work. And so as you work deeper into the retracement, we need to see a little bit more than just simple or standard confirmation. We need to see what we call the King's Bed pattern, which is more short-term consolidation. And so once again, when you're looking at that, Mark, I just find, and for those of you listening, I have some visuals on a chart here, but when you're looking at that, once again, that standard bull flag based pattern, you don't need to see much. You just need to see that simple confirmation. Whereas as you start to work deeper and deeper, you got to see a little bit more, quite frankly. And so when you're looking at the depth of the retracement conversation, and once again, we're going to have this conversation in detail from an education perspective in the coaches show this week, but that's all you're tracking. And so when you're dealing with market corrections, Mark,
Coaches show Tuesday, 8:30 p.m. for pro members.
When you're looking at market corrections, I see this very similar to how I look at a bullish retracement. There's multiple different levels you track, two very, very important levels, and that would be the pullback and the correction type levels, because if you don't confirm at the pullback or the correction levels, you can start working into that bearish type analysis where it is a little bit look out below, because if you give up so much, it's just going to start feeding into one another. And so, but the reason I don't get emotional about pullbacks is, once again, most pullbacks, most corrections, every pullback and every correction leads to a buying opportunity. Not every bear market does, but every pullback and correction absolutely does. And right now, when you're tracking that overall market correction, a market correction is a 10% drop from the top price. That would put you, in terms of that 10%, right around a 4,800 zone. The pullback is about a 5% drop from the top price. That puts you right around 5K, where that 20 period moving average is. And so if in pullback language here, if you're looking at the pullback in the marketplace or the market correction the same way you look at a retracement, the first level is pullback versus the momentum flag-based patterns. You look for confirmation here. You look for a support build here. And if you get that support build, that's the indication that we're at that level. The selling is starting to end and the buyers are now starting to step in. That's why you have to see a market start to build support. And that's why we're tracking that 5K level right now. Now, if that 5K level gives up and it gives up that 20 period moving average on the weekly chart, you start working into deeper correction territory. And that's where you see the market coming down another 200 points or so into that 4,800 zone. And that 4,800 zone is going to be an extremely important zone. You got some moving averages right north of that zone. That's a previous pivot point. That's also about a 50% Fibonacci retracement level from the entire trend as well. And so 4,800 is going to be that next level that if 5K doesn't hold, we're immediately looking at 4,800 saying, do we get a support build at 4,800? And then if 4,800 doesn't hold, at that point, you got to get a little bit more concerned about the overall marketplace and whether or not this is just a correction or if it's something else. Because from the correction, if we don't hold in correction, you can immediately see that that bear market analysis start to come in. And so there's always variables out there right now that can lead into the ultimate bear, but we're not there in the story here. We're in the pullback language of the story and tracking to see if that pullback gets confirmed this week and whether or not it does or doesn't. If it does, we're looking at probably a fairly decent catalyst that also kind of transpired this week. But if it doesn't, then you're just looking out for about 200 points below, and that puts you in that 4,800 zone.
Yeah, no, great analysis, great analysis. And what are we now? About 6.5%, 7%, somewhere in that range.
I think we're like right around like 6.3 or something.
Yeah, something in that range right now. And don't get caught up on the news. Well, this is technically a six. No, we're talking general ranges here. General ranges here. You get these big, gigantic rallies that never break. Well, in modern markets and Mountain Dew markets, they tend to break a little bit harder. But the technicals and Matt, the history of the market, you and I are chart historians. We both love looking. Markets can be very, very cooperative in forming bottoming patterns. They tend to do it a lot. I think back at September 2021, first correction off a big rally, nice reverse head and shoulders. Like patience pays here. It does. This is not don't be a hero environment. This is a volatility playbook environment. This is a piddle, don't pound environment, and let the charts do the talking, right?
I absolutely believe that as well. Patience certainly does play. We're going into a really big decision week in the market where you're starting to get more catalysts, more potential catalysts that could either continue the volatility or start to see a changing behavior. But at the end of the day, Mark, when you're tracking the pullback, and we do have a short-term bearish downtrend against the longer-term bullish uptrend here, you're going to need something. You're going to need to see a reversal here. You're going to need to see, as we start working to the pullback language, the difference between a flag-based pattern in a bullish uptrend and a pullback against the market is a pullback against the market is a short-term bearish downtrend against a longer-term bullish uptrend. You got to see that work itself out. And the only way to start working that self out is to go through slowing momentum in the downtrend, to start to see bearish retracements here. We haven't even started to see a bearish retracement here, let alone a reversal. But you also typically want to see catalysts that the market starts to look at a little bit differently from an earnings perspective as well. So yeah, I don't feel this is the week where you're like, oh my goodness, that like we have to be in front of the market every single day because it might, give us that pivot point confirmation. No, I think we're looking for a little bit of consolidation here, quite frankly, and to start to see this week start to build a little bit of support because recently we haven't seen any support builds in the market.
Yeah, no, we have. No, we have. I mean, talk about, like for someone that has our general playbook where we're like, all right, we're going to, and I tend to maybe be a little more aggressive than you do. There's been nothing like nothing, and there can't be anything tomorrow, and there can't be anything on Tuesday. And it's going to take time to build this. In one sense, the market has not given you any fake outs at this point. It's just sold, right?
Well,
what have we had 6 red days in a row?
Make it easy then. I mean, if there's one thing you want to see more than anything, regardless of the causation or the topic or the analysis, you want to see a slowing momentum candle against the macro backdrop of the marketplace, which means you want to see a doji on that weekly chart this week. And if you see a doji on that weekly chart this week, that's going to show you that most likely the second most important thing, and that to me would be an earnings conversation and seeing a change in behaviors with how the market is responding to the first week and a half of earnings season, which has been sell first, ask questions later, basically. Well, if we do see a doji this week, That's most likely because we've seen a shift in how the market is looking at the earnings backdrop as well.
If we see a doji this week, and we'll get into this a little bit more here in a minute, you probably saw the combination of some okay earnings, probably had an inflationary report on Friday that wasn't too shabby, or at least didn't scare the market. Probably didn't have any escalation in the Middle East, right? You know,
I would say it'd be better than all of that, because right now the market is selling positive information. It's dumping bad information. It's selling positive information. You can think about like selling positive information is, well, we're just alleviating some bullishness from the market. We're locking in some profit against the greater overall uptrend. You know, dumping is, we're not just going to dump our stock. We're going to borrow yours and dump it for you as well. And so bad news is getting dumped by the market. Positive news is getting sold by the market for the most part. So if you're going to see a doji this week, it's going to be based on a better than expected performance coming out of earnings and a better than expected performance coming out of that PCE report. So if I see a doji, I think that is a really good positive step. And I know, like, bulls oftentimes in the short term, they want to recover long term in the short term. So meaning that a lot of bulls will be like, oh man, just V shape here and get back up into 5,300. I would love to see development here.
You can't trust a V here.
Give me development here. Any V-shape rally is going to be met with fierce resistance.
Yeah, because here's what's going to happen. You know, now any V. Let's say you have a strong update Monday, Tuesday, whatever.
I'll fade a V-shape.
I'll fade. My playbook on any strong counteract V-shape type action is reduce exposure, be more aggressive with covered calls, and look to
100%
add some bearish exposure. It's a strong fade on uncontrolled green.
You V-shaped at 5,300 in this.
Daddy won't have any exposure if that happens.
No, that's dump things that you regretted not dumping to.
Yeah, no,
yeah, and reduce exposure and get ready to trade some bearish positions.
Yeah, the foundation in which the rally comes off is going to make the entire universe. You get the right technical formation, Matt. I'm adding. I'm adding. And I'm adding.
The overall macro environment is not a terrible environment. It's a complicated environment. It's not a terrible environment. Terrible environment would be if we're having this double dip inflation.
We are not at 0% interest rates on our way to 5.5. We are at 5.5 and market's throwing a tantrum. There's a difference.
That's why I don't think this is an interest rate conversation. My general point on that, though, was a terrible environment is double dip inflation plus the geopolitical conversation that we're having, which is right now, plus a terrible economy. That's a terrible environment. This one is a complicated environment of positive economics, but concern about double dip inflation.
Yes. I mean,
geopolitical situation.
A couple of months ago on this podcast, and we have maintained that stance, have called for a neutral environment based on a lot of that analysis, right? And, you consolidate, come back up. That call's gonna look really good.
We've officially been neutral for the last 2.5, 3 weeks.
You and I go back to our neutral call.
We go back further than that because the rankings. I'm referring to the top.
Yeah, you and I in the podcast.
But we're usually a little bit in front of that because in the official rankings we have to take into account historical trends as well.
Yeah. No. Do you want to talk about anything else? Teach anything else on the retracement?
No, I'm going to have a detailed conversation on Tuesday's Coaches Show regarding regarding corrective languages. And what I'm going to do basically is I'm going to teach the combination of two things: the 3 stages, the 3 stages of a bullish retracement, the levels of a bullish retracement, and the specific patterns that you need to see at a bullish retracement. And I'm going to then go through the 3 phases of a market correction. And I'm going to talk about the different types of patterns you need to see in that market correction, because you can understand market corrections very similar to bullish retracements, because market corrections are a little on a longer time frame, but they're very similar to bullish retracements. But the type of patterns you're going to need to see on the daily chart are going to be vastly different in correction language, because you're dealing with a short-term downtrend against a longer-term uptrend, whereas on a bullish retracement, you're just tracking the same time frame. Does that make sense?
Oh, absolutely. Well, yeah, for me, as a technician, you know, and if that confused you a little bit, Matt breaks it down with charts. It's going to be what the whole coaches shows about it.
Yeah, listen, it's my goal on Tuesday to make sure our community understands exactly what they need to see transpire so that they can make better decisions, more informed decisions as we're going through this. Because again, every single degree of correction in the market history has resulted in a buying opportunity. Every single one throughout history has. Now, that means if they get confirmed in corrections, if they start working deeper, obviously that's a different conversation. And so we need to understand the patterns that need to develop at these key points and the different types of catalysts that can provide those patterns. And that's where I'm going to teach in detail this Tuesday.
Yeah, look forward to it. Look forward to it. Absolutely. And Matt, we got a big week ahead, right? Like this is a big week ahead where we have key inflationary data on Friday that is preceded by very important economic data, right? Mm-hmm. And then we got earnings. We don't have any Fed speak, Matt, because they're meeting next week and they're all in their blackout period. But we got we got a heavy dose, and it was the most hawkish week I have seen since pre to December.
Give a quick update on that, because I am completely sick and tired of Fed speeches recently. I know you have been very awesome to review and watch and listen, and
I either watch or check the notes on every single Fed speaker. Yes, this is true.
You talked about this in the newsletter this weekend as well, in your write-up of the economics section, which is one of the sections of the newsletter. Can you just give a quick update for the podcast listener?
Yeah, Powell spoke this week, and he was the least dovish that he has been since the December pivot. He omitted things like referring to inflation as a bump. Like that's been one of his favorite phrases for months and months. Well, this might be a bump, didn't refer to that, didn't refer to rate cuts at all. These were, these are things that necessarily don't catch headlines, but the omission of dovish language from his remarks, well, de facto is a little bit hawkish. Other Fed speakers weren't shy at all. Michelle Bowman was my favorite one because she outright called whether or not the Fed interest rates were being restrictive to monetary conditions at all. Like just openly questioned that. Yeah. You had the little trial balloons of, hey, listen, it's not my base case to raise rates, but it's not 100% out of the cards. Williams threw that out there this week, kind of that. We're not planning on raising, but we're not going to close the door 100%. Just top to bottom was a very Mohammed El-Erian, really well-known market commentator, actually referred to this week as a pivot on the pivot. I wouldn't, I wouldn't go that far, but I did appreciate
I liked it. I
liked it, right? Like referring to this was really a more hockey.
Only Fed dorks like ourselves would get it, but yeah, I do like it.
And so this was not for a pivot on the pivot for me.
But I agree in general with the Fed speeches from last week, and I was kind of kidding when I don't. Of course
of course you do. I know you, dude.
I just like to say I don't because they're driving me crazy right now. But
how do you moonwalk? Like I saw Michael Jackson moonwalking all week. Let's moonwalk back from all this shit we've been saying for 3 months.
I feel like transitory is happening all over, and I think I feel like they're gaslighting us nonstop right now. because yes, I do feel like they're gaslighting us nonstop right now. But I will say this: last week, from Powell to the other 14 different speakers last week.
Oh, that was just on Wednesday, dude. There were a billion
Didn't
speeches.
they all say the right things?
Even Goolsbee, who is the biggest gaslighting, dovish sycophant on the Fed, even more than Powell, he was even like, oh, I don't know. It kind of like we're going to have to probably wait and see. Like he had been totally gaslighting. Inflation's coming down. It's non-issue. It's non-issue. Even he backed off this week. There was a coordination here.
Yeah, they wanted to get a message out there. And
their message is, please don't remember us for screwing up again. That was the message. That was the message.
I have a different take on it. They wanted the market to do their job for them.
No, so
they wanted the market to lead, which means they wanted the bond market to reprice in the potential risk, and they didn't want to raise rates, and they didn't want to do anything about that. So they wanted the market to price it in for them. Market did it. And so, like, why do we have a Fed if the market's just going to price in the bond market and do the Fed's job for them? Now, whether that continues or not is a vastly different conversation. But in terms of them talking tough, yeah, they're saying the right things. I think this is really, really simple, Mark. I really do. If they start cutting in June or July, they're going to go 2 or 3 cuts this year, and it's going to be based on the refinancing issue. If they do not start by June or July, they're not getting a cut till December, because they're not going to start a rate cut environment in the last 3 months before an election. It's just not going to happen. If we're having conventions, the Democratic and the Republican convention, we're not going to be having, is the Fed going to cut for the first time? That will be seen as a political decision, and it will be seen against Donald Trump, and it just will not work, and the Fed's going to be sensitive to that. And so, to me, it's really simple. We'll see exactly if the Fed is really committed to this fight against inflation, because if they start cutting before July, it's because of the election and because of the refinancing, and it has nothing to do with inflation. If they do not start cutting by July, because I do not believe this environment deserves a cut in any capacity. In fact, I think Volcker, if he came back for a day, he would jack up the interest rate to like 15%, and he would just
like, let's get this over with.
Like, rip the Band-Aid off. You guys are going to deal with some pain in the next year and a half, but we're going to get back to a normal economy. That's what Volcker would do, and I would agree with that, quite frankly. But in terms of what they're going to do, we'll see if their talk is just talk or if they're actually committed to this inflationary fight. Because, again, I don't care what the dot plots suggest. If they don't start this conversation by June or July, they ain't going to start until December.
Yeah, no. So,
and they know that.
But we don't get any of their yapping this week. Fed meeting next week. We'll highlight it on the podcast next week. But we do get an inflation. Inflation is, Matt, it is, we've been talking inflation heavy on this podcast for months. And it was kind of in the back of minds of traders. Then it became in the front of minds. And now it's just swirling in an ethos atmosphere all around every market participant. Needless to say, when you get a key inflationary data point like we do on the core PCE price index this Friday, it's a big highlight. It becomes, circle it red, double red, triple red, wave the red flag in front of the bull, no pun intended. But it's a big one on Friday, right? We haven't seen a jack up in the forecast. You know how you've seen sometimes them bumping up. Now the week's still young. The week's still young. We'll see if that 0.3 gets jacked to a 0.4 or even higher. That's it, right? Because you could have strong or weak, and this is, economic data. We have flash PMI, we got advanced GDP, probably come in strong because that's been the modus operandi of economic data recently. But it all comes down to that, right? How many arrows? I think that is 22.
Trying to color up all the other economic reports because the only one that matters this week is core PCE.
Yeah, and it comes out on Friday morning, and it comes out on Friday morning. And so it'll be interesting seeing the technical situation heading into Friday, right? If you've developed a low base, if you've just been selling, we have no idea if you've knee jerked in front of it.
We could be talking 4,800 by Friday, and we could be talking about, hey, this is the ultimate support test right here, because I don't think 5K is the ultimate support test. I do think 4,800 is. So yeah, we could be talking about a vastly different conversation by Friday.
Yeah, we have no idea what the technicals look like on Friday, right?
No, not as of right now. You got heavy selling in technology. You got slowing momentum in defensive and cyclical. We're in the middle of pattern development and support builds, and I'd love to give a better answer, but as a technician and I can't. Patience plays here. So, but in terms of the economic landscape, there's really kind of, for me, two reports this week that are a little bit more important than others. The combination flash manufacturing and services PMI numbers on Tuesday. Those are really economically sensitive, cyclical sensitive type reports. That's going to give a little bit of economic data. And I do believe manufacturing and services PMIs are going to be moving a little bit more important in the future. And then obviously core PCE price index, inflation is the preferred gauge of inflation at the central bank. And while they aren't going to be talking to us this week, the PCE report is going to tell us everything we need to know about what the Fed is thinking going into their next meeting. So,
listen, we're going to see if there becomes something important. It'll be interesting to see if Nick Timiraos, Nick WikiLeaks, gives a message from the Wall Street Journal. He's known to get out information at key points that the Fed wants to communicate.
The Fed wants to cut more,
they desperately so want to cut. You just see the $1 trillion in interest payments.
Yeah, they want to cut so bad their teeth hurt. So if PCE comes in less than expected, do you expect to see the market shift their expectations for the June-July meeting? Or do you kind of feel like we kind of know where we're at?
How bad do they lie on the data? Is it really does it miss? I mean, because the problem with the PPI report is they lied and everyone knew it.
Yeah.
They lied on the gas and everyone knew it. And you've seen the market sell off every freaking day since 6 straight days.
It's true.
So it's got to be credible. I mean, this is a problem about manipulating data. When you lie that bad, when you gaslight that bad, where people are just open.
We do not care about terrible, horrible, horrific data. We will price it in. We want to make decisions based on real information. We do not need to be gaslit about inflation and lied to, because we all know exactly. You don't need to study inflation over the course of the last 100 years and understand every hyperinflationary situation and what the central bank does to compete it. When you just go out there and you put gasoline in your vehicle, or you go to the food store or whatnot, you know inflation is impacting you. And so, yeah, it's fascinating to see it from the Fed's purview. But
yeah, listen, I mean, you could have like a lot of situations where you just get a strong counter rally that doesn't come off a foundation, because there's a lot of put buying out there, right? I mean, it's not been all bad news, right? You've had de-escalation potentially in the Middle East. Earnings have not been like, oh my gosh, right? We'll break down. I want to get those numbers in fact, I want to get those numbers from you right now, Matt. What has earnings season done at this point, and what are we looking at on the landscape?
Well, in terms of earnings season specifically, and like I said at the beginning of the pod, there's two really important equations this week. The first one is understanding that correction and where does support start to build in the correction. Does it start to build at 5K and thus a pullback? Does it start to build at 4,800 and thus a correction? Or does 4,800 give out and we all start getting a little bit more bearish? That's the number one most important thing to me is where does support build against the backdrop of the support catalyst against the market correction conversation. What can influence the 5K, the 4,800, or whether we're talking about something a little bit worse is whether or not we start to see the market behave a little bit differently in regards to earnings season. Now, I'm not trying to say that earnings season has been fantastic and the market is completely bucking the trend. Earnings season has been average. Earnings season has been very similar to what we went through last earnings season. What we have seen, though, is in this earnings season, the market is punishing the stocks that are coming in at average or a little bit less than average more than what historically the market has. Does that make sense?
Yes, it does.
Okay. And that is really the only theme that we have seen develop through earnings season so far is the market reaction has been a little bit more negative regardless of the numbers than what we have seen historically. Now, when you're looking at the three things we track from an earnings perspective, we track EPS, we track revenue, we track forward guidance. When we're looking at earnings season as a collective, we like to look at EPS beat percentage, revenue beat percentage, as well as the blended growth. And when you're looking at those three things right now, what you have is on the EPS side of the equation, after the first week of earnings season, we were beating at about 85%. That number in the last week, when we had about 41 to 45, depending on the S&P and the Dow components, report last week. So we got about 14% of the market reporting right now. That has contracted from 85% beats down to about 74% beats. Now, on the revenue side of the equation, we started off earnings season with the financial companies on a sour note, obviously, but we were only looking at about 53% beat at that point. A lot of that was on the healthcare side. Now, what the revenue beats have increased to, and they got about a 5-year average at 69%, and I expect this to continue to go up, is they started after week one at 53%. Now we have 58%. This is not abnormal, by the way, for the first week to 2 weeks in earnings season. Usually I see a high EPS beat percentage coming out of the banks, and that gets back down to a little bit more mid to high 70s throughout earnings season on the EPS beat percentage. On the revenue side of the equation, this is not abnormal either. You saw it starting in the low 50s. Sometimes it starts higher than that, but typically the revenue beats will increase, whereas the EPS beat percentage will decrease throughout earnings season. Now, one number that is, in my estimation, more important than other numbers when it comes to understanding the quality of earnings season is the EPS blended growth rate. And that ended the quarter last quarter. Remember, we're talking about the first quarter reporting period. That ended the quarter at 3.4% expectation. Now, remember, blended growth takes into account two things. It takes into account the companies that have reported, and it takes into the companies that have not reported, but what are the analyst expectations? And so on March 31st, that's all based on analyst expectations. That's not based on what actually has reported, because not a lot of companies have reported yet. Well, after the first week, that decreased to 0.90. So we go from 3.4% blended growth. And again, we need to get to 5 to 6% to have a good earnings season, because EPS is always expected lower. And then you get 75% of companies beating the EPS number, which drives the blended growth back up. And so you got to get into that 5-6%, and some actually think 7 to 8% to even suggest this is a good earnings season. We're going in the wrong direction on blended growth. We went from 3.4% down to 0.9% to this week at 0.5%. Now, it's important to understand the context of what's driving this, because a lot of people, when they look at this number, they might say, man, we went from 3.4 to 0.5% in the last 3 weeks. That's got to be horrific. And yes and no, it's not a good start. No, I'll give you that. But for the most part, the blended growth is not down based on the 14% companies that are actually reporting earnings. The blended growth is down significantly due to two companies. And those two companies are Bristol Myers out of the healthcare space and Biogen out of the healthcare space. And so we had two revisions in guidance that were significant, that were so significant that it brought down the blended growth so aggressively. This is the week, Mark, that is the make or break week from an earnings perspective.
Oh yeah, we get a cross section from
Yes.
this. This is my favorite
week.
This is my favorite. Give me the big picture because I get a little bit of everything. I get a little.
We're going to have impacts in almost every space there. And so this is the week that I typically I don't get too excited around blended growth and the EPS B percentage and the revenue B percentage until week 3 in earnings season, which typically we start to see a lot more companies, for example. So when you're looking at earnings season this week, let's just say, okay, how many S&P 500 companies are reporting this week, Mark? We have 158 companies reporting earnings. Damn near a third of the entire index is reporting this week. When you're looking at the NASDAQ 100, you got 27% of the NASDAQ 100 reporting this week. NASDAQ was on fire last week, getting absolutely smoked last week. Well, I'm willing to bet 27% of the space, including Microsoft, Google, Meta, and Tesla, is going to have an impact on the NASDAQ out there. In the Dow Jones, only 30 stocks. We got 11 stocks reporting next.
It was a big week
as well. And so when you're looking at next week, and again, it is truly murderer's row of companies reporting earnings, I'll just give you the most important ones each day, okay? Each day. Now, on Monday of this week, we're not going to get a lot of important ones. You get, I would say the most important one for the market is probably Verizon. The most important one, I think, for tackle trading, knowing the types of individuals we have in our community, I would say Cleveland Cliffs, Nucor, Albertsons, and Truist would be the big ones on Monday. When you are looking at Tuesday's kind of that. After the market closes on Tuesday is when we start having the real conversation. And the real conversation is the Mag 7 components that are reporting this week. And do we see a change in behavior on the Mag 7? Do they decide to be leaders? Do the generals step up and lead from in front of the army, or do they just bark orders from behind? That's what we start to see this week. And on Tuesday, we get Tesla after the market closes. You look down the list, though, and there's just a lot of other companies on Tuesday as well. GM, GE, both those two generals have had a really good year so far. Raytheon, Halliburton on Tuesday. On Wednesday, I really don't care about Boeing right now other than hating on them. But I am interested to see what they have to say on their earnings results. But on Wednesday, you got Meta. Meta's the big one on Wednesday. There's no doubt about that. That's going to be a fascinating one. That's a market mover for absolutely certain. But you also got Ford, Chipotle, who's going to be splitting 50-1 coming up fairly soon. They're also reporting on Wednesday as well. Then you kind of get into Thursday and you get Microsoft and Alphabet and Intel and just Newmont Mining, Caterpillar, just for the basic material industrial space. And then on Friday, we get the leadership out of the energy space as well, ExxonMobil and Chevron. So it is a really big week in earnings next week, and this is a catalyst week. There is absolutely no doubt about that. This is a decision week for the market regarding the earnings conversation, and whether or not we're holding at 5K and talking about that doji next week, talking about the upward movement in price created next week, or talking about further continuation to the downside in the market correction story, it's going to be on the backs, in my estimation, of earnings and how the market sees earnings this week.
Yeah, absolutely. And we'll be there every day in the halftime report. Let's spend the last couple of minutes go through some global markets really quick. Matt, dollar is set up in a high base formation. So are yields heading into this week. Gold hasn't really seemed to care, but give me just a read on that technical, not a lot of pressure. It was kind of a nothing week, but from a technical perspective, you often see this in uptrends where it has a big surge and takes a week off, right? Where a surge and take a week off. Dollar here.
I don't think we
Breaking
got to be too nervous about the dollar as of right this very second, because we're already in the pullback of the market and the dollar's already already in a short-term bullish uptrend. I do think there's one level that we can anchor against to basically say at this point, all right, we know,
additional pressure, maybe.
yeah, we know the score today, but where does additional pressure the dollar could put on the marketplace? And I do think you get a little bit more concerned about the market in general if you break that 107 level. If you break this 107 level, you got free reign up to 114, quite frankly. So I don't think you got to be too concerned if the dollar just wants to kind of go between 106 and 107 and consolidate. But if you break 107, you have the ability to run. And if the dollar runs, that's going to put a tremendous amount of pressure on the market, and specifically the S&P 500.
Yeah, absolutely. And gold so far has been impervious to everything. Like, just has not cared about anything. Are you seeing anything different on the chart as of today?
No, it's had really good development, more similar. I think the open question on gold recently was, are we going to see something similar to the overall correction we saw in gold after it broke the 2K barrier, hit 2100, and ultimately settled in around 2K? Or were we going to see more of the short-term consolidation similar to what we saw in March, where we formed a little bit of a short-term consolidation breakout pattern between 2150 and 2200? It certainly has behaved more like the continuation side of the equation than the pullback side of the equation. It looks pretty good here, Mark. You're anchoring against 2400. I obviously have a very, very positive bullish opinion on the long-term side of the equation. Short-term, you're tracking a high base type situation, but there's not a flaw in the analysis, in my estimation. I don't know how far you think this can go in the current environment. And quite frankly, if you're looking on the short-term trading side of it, gold and silver look very similar to one another. I wrote about it in the Tackle Trading newsletter when we were talking about the GSR ratio, the gold to silver ratio. And one of the things I talked about was, using how traders and investors can use the GSR to help them make decisions. And one of those things I talked about was, if you got gold and silver looking very similar, well, GSR could be a tiebreaker in those situations. I like silver here as well. It's looking very similar to gold. And the difference is, if gold wants to break out and run, you're breaking out of an all-time high price and running. If silver wants to break and run here, you're not breaking and running in terms of an all-time high. You're pretty clean right around that $30. And so you're looking at 29 on that high base on silver, saying, all right, if we can get above 29, that's a good trigger. But ultimately, that's front running in front of the $30 multiple time frame breakout. And so I think silver's got to be on the radar as we start dialing in both 29 and 30. Both of them are really, really important resistance zones. And specifically, that $30 breakout could see that little bit of catch up analysis in gold and silver. So gold's fantastic. Love it. Don't have anything to update on that. But if silver and gold are rocking very similar like they are right now, and you got a little bit more open-ended environment on silver might want to be looked at a little bit closer.
All right, let's go over to oil real quick. What's funny, Matt, is here we are about an hour into the podcast wrapping up, and we're just going to really talk about the Middle East situation for the first time, which is amazing in the sense that we've had 350 missiles and drones fired at Israel. We've had a retaliation attack, and we're just talking about it now from a market perspective. Now, we could talk about it as a human perspective, as a political science perspective, but from a market perspective, we're just bringing it up now with a couple minutes to go in the podcast. Why is that?
Because I think that's I think that's probably the level of importance to the analysis right now.
That's what I think too, which is why, right?
It's important to understand, but in the backdrop of this week, the market correction in combination with the earnings and the catalyst that can be provided therefore, that's just going to be a little bit more important than whether or not we're debating whether or not this is a fake war or a real war. And let me give context to that.
I think it's both.
Because it's both. It is. The real situation is a general escalatory situation in general. But I do think myself, you, and many in the market are a little bit boy who cried wolf.
Like man, I've moved it to
Uh,
a non-story in my own personal analysis in the short term. And I mean, you had Iran completely downplay Israel's attack. Israel's attack was, well, one of the Israeli war cabinet members called it a joke. Like he said, that's a joke, right? And so,
Israel wanted to let them know that they could hit them at any point they wanted to hit them. And Iran wanted to, do a little showmanship there.
I think the market moves beyond this one without it's like they're going to have to prove that this matters again, or the market's going to move on.
Like I said, I kind of it reminds me of the boy who cried wolf a little bit.
Yeah.
Certainly, there's a wolf in the story, right? Certainly, the wolf comes. Certainly, there's concern on the bigger picture macro side of the equation. But in the last 3-4 weeks, we've dealt with a lot of will they, won't they. And in the will they part of the analysis, the ultimate conclusion, regardless of what Twitter thought in the moment, the ultimate conclusion was de-escalation, that the market, maybe not the market, but the political side of the equation saw it as a short-term de-escalation, both in terms of what Iran did with launching. And I know it's crazy to think about Iran launching 300 missiles and projectiles and drones and seeing it as a de-escalation. And I know it's crazy to think about Israel punching Iran in the middle of Iran, hitting a military
and here we are on a Sunday, 2 hours before futures open, talking de-escalation.
It's crazy.
But that's the way it played out.
That's the way it played out. But in general, I can't say that the environment is in general a de-escalation environment. You're talking about a very hot situation.
No, the Houthis are still going to attack container ships. There's still going to be, war on the ground, near,
and Israel just punched Iran in Iran for the first time, and Iran launched a direct attack against Israel for the first time. Those are first time ever. Like, those are important to understand. But again, it's just one of those situations where we have to debate, is this a real thing, or is this just another show or sign of force by one or the other? And I do think the market moves on the same way the market,
especially in a week where you got so much going on, the market's going to move on really, really quickly.
So if the market moves on then from that being a, oh my goodness, is this going to, turn into something bigger? Doesn't support just start to play out here? Doesn't
well, I think you have the chance that the market buys into the de-escalation and oil shorts, because maybe because I think what happened, there was a lot of oil speculators when the terrorist attacks happened on Israel. I think a lot of oil speculators, there could be an attempt to flush out oil speculators that were betting on Armageddon, right? And so you let this play out, but I think in a week from now that started to play out, right? And we'll see what the technicals look like.
Yeah, all I know is I like the 82 to 80 support level. At 82, that's the 9 weekly. That's an old pivot point in the marketplace. Technically, that makes a lot of sense.
Oh, if support holds here in the face of de-escalation headlines, add some oil, baby.
Yeah,
because there is a strong fundamental case in this environment for it.
I do think that you can paint a strong fundamental case, and if the only other case is de-escalation from a war that we don't know if it's hot or not, once again, don't you just get back to the Saudi Arabia's cutting and the global economy's improving?
Yeah, no, and until that changes and money is flowing in an election year, I think I don't know if it's more complicated. You just need a technical story as well. And, we had a lot of areas of the market. The Friday was a bloody day in semis, bloody day in tech. You had no shortages of markets counter punching on Friday. My individual stocks that I still own, I had as much green as I had red. My NVIDIA naked puts was not one of those in the green.
No, Nvidia decided to dump. When you're looking at the Nasdaq performance last week, what you're really looking at is Nvidia's candle on Friday. But no, it started dumping. There's no doubt about that. And when they started dumping, it just continued. But Nvidia, I'm sorry, I'll see this, especially if it ultimately concludes at 700. I'll see that as an opportunity to get in.
As will, I think, almost every human being that has sense, right? Has sense. Taiwan Semiconductor earnings report was decent. They just were. That lets you know a lot into NVIDIA's backdrop, being such a large customer of that. And then, Matt, historic, wrapping up last story, historic moment this weekend in Bitcoin. It was the halving, where I believe, if my math is right, you go from 6.5 down to 3.25. So you don't get as much. If you've been mining, you don't get as much this coming week as you got previously. You only get half, hence the term halving. It's the fourth halving in history. Interesting, just a reminder to me and everyone else of the limited fixed supply of Bitcoin, fixed at 21 million in a world of unlimited fiat currency printing. Technicals are messy, and that's what the short-term analysis is for me, right? I already had a long-term fundamental belief. I just need some things to calm down here.
Halvings are usually seen as bullish for Bitcoin analysis in months to years following. But then again, I think you can say that for any analysis on Bitcoin over the course of the last 13 years. You're talking about something that went from 10 cents to 65,000. I think most stats would project to the bull side of the equation in that environment. So for me, this is a technical conversation.
I love what you just said there, because markets, bulls will. Do you know that it's bullish? Yeah, the market freaking history is a left to right on the chart. Assets climb.
Yeah.
Yes, most scenarios are bullish over time. Doesn't help me today.
Bearish stats kind of play out a little bit more, but in terms of the analysis, to me, this is still choppy as choppy gets out. Does it lead to a conclusion on the buy side? It certainly can. If 60K holds and we start going through W formations here, that's fine. Let's break it down as it does that. If you fight back up to 75 and you start getting into a better technical breakout situation, or if you start to work lower, I just don't think it pays. And I say this all the time in uncertain environments or environments where you can really see it play out both sides of the equation. I could see this playing out to the top side very easily, and I could see this playing out to the downside very easily.
It's a hard chart to read right now.
In those environments, I don't think it pays to have a strong opinion. And so I think you just got to,
because we have not had such a dramatic, because I'll start running my mouth on assets I love if it's a big, huge sell-off, and I'll be like, I'll try to catch a falling knife. I will, if it's on something I believe long term. But you haven't had a dramatic sell-off. You don't have any support level underneath.
I haven't seen a shift in behavior on Bitcoin in the last month. So
so it's just like, all right,
up, down, it's all the same energy.
Interesting having little dooley dip, but we'll see how it is. Well, Matt, I've enjoyed the podcast very much. Covered a lot of good material. Once again, Coach's Show. Sign up. If you're watching this podcast on a Sunday night or a Monday or a Tuesday, we're going to have that Coach's Show. Or even if you watch it after, sign up for pro membership. You can watch the recording. Matt is going to do a masterful job. I know my brother, he's an expert. He's a world type best at retracement analysis. You're going to want to understand what you're looking for in the coming days in the S&P 500, in the NASDAQ, in NVIDIA, in whatever it may be that you got your greedy little eyes on, like myself. Sign up for that free pro trial. But Matt, let's wrap up 575 and you give us some final words.
Yeah, I'm real excited to teach this Tuesday for the Coach's Show on bullish retracements, but really understanding market corrections. And that's what the real topic is. Understanding the levels, understanding the language, and understanding the patterns that develop at those levels. And again, one thing happens when you start to understand these things. you don't freak out as much about them when they happen. You just kind of let them play out, because trading and investing is a very long-term game, even if it's played out in the short-term time frame. So hopefully you enjoyed that, pro members. And if you're not a pro member, best way to do that is go over to tackletrading.com, hit that get started, and sign up for a free 15-day free trial. And like Mark said at the very beginning of the pod, the reason you do that is you want to get that Tackle Trading newsletter so that you are staying on top of the market, everything that's impacting the market on a week in, week out basis, so that you can navigate the market with confidence. And then the second thing is you want to stay for the community, but that Coach's Show is a really close second to the newsletter there. So let's have some fun this Tuesday, pro members. And if you're not a pro, come and join us and be a pro member.
Everyone have a fantastic week.